What are investors thinking and doing in these volatile markets when it's so hard just to keep track of the headlines? Today, we're thrilled to be talking to David Busch, Co-CIO of Trajan Wealth Management, which manages over $2.6 billion in client assets and is active in 40 states. He shares his insights on what clients are worried about and how to navigate today's markets. You especially don't want to miss his thoughts on private markets and crypto. Let's dive in. We're very excited to have David Busch, Co-Chief Investment Officer of Trajan Wealth, a comprehensive integrated financial services firm that provides fiduciary, legal, and tax advice and manages over $2.6 billion in client assets. As Co-Chief Investment Officer at Trajan Wealth, he develops and implements firm-wide investment strategies and guides asset allocation. His expertise spans fixed income, equities, alternatives, and derivatives, optimizing portfolios to enhance risk-adjusted returns and align with client goals. He holds a bachelor's of business administration from New Mexico Highlands University and is also a CFA charter holder. David, welcome to the show.
Thank you so much for having me. I'm excited to be here.
I'm kind of jealous. I see this beautiful, scenery behind you in the Arizona sunshine. Must be amazing.
That's right. This is the time of year you want to live in Arizona. But what we tell people is that those who love us come visit us in July. That's when it's like 115.
Yeah, I'll go with February. I think if I can, but
Absolutely.
so for our viewers, can you just give us a brief summary of what Trajan Wealth does? It seems like you guys are in a sweet spot where you give advice along all parts of of the firmament. And then what are your responsibilities really like, as co-CIO?
Yeah, so Trajan Wealth is a nationwide registered investment advisory firm, and we really have a comprehensive family office dynamic here. Essentially, we have wealth management, tax planning and preparation, estate planning, and document preparation. So all of the families that come in, as our clients come in, we have multiple areas that we can help them, as they plan through their for their financial future. So that's really Trajan Wealth in a nutshell. My role here as co-CIO is multi-asset strategies, alternatives, um, essentially establishing the model portfolios, the managed equity portfolios, all the trading and operations behind that as well.
So, I can only imagine how busy Trajan's switchboard has been over the past couple of months. Um, what are the clients from the high net worth folks to retail to retired folks? What are they asking when they call? Like, what are they worried about? Is it all about the war? Are people going to cash? Are they still putting money to work? What are the clients thinking here?
Yeah, that's a great question. And really, I think a lot of what's happened is, just the increase in volatility essentially and the market swings. And my role there is to have outbound messages, whether it's a blog post or an email that we send out to our clients to just make them aware, this is what's causing the market volatility. Here's how we're reacting to it. And ultimately, at the end of the day, you and I have both lived through several of these cycles. I started my career in January of 2000. And so I cut my teeth on the dot-com bust and lived through the global financial crisis and so on. And essentially, we've seen these cycles before. And the key is for investors, especially like retail, high net worth, ultra high net worth, is to stay invested and think long term. And what that means is focusing on quality companies with solid balance sheets, positive cash flows, positive earnings, and so on. Because as you know, and I know from our history, is that markets can sell off and they can rebound really quickly. I mean, we saw that last Friday where the Dow Jones and S&P hit all-time highs, and that was on the heels of a pretty major sell-off. So that's the key, is to be patient, think long term, stay invested. And essentially our role in this phase of a market cycle is to be the steady hand at the tiller, just to make sure that our clients are aware of the volatility, and we can help position that appropriately for them.
So, are there certain like I guess, kinds of clients who are more worried than others, or are they just shrugging and saying, "Oh, this, this too will pass"? Like, what are some of are there any specific concerns that you would just like flag and say, "This is what, some people are thinking"?
Yeah, it's really around the market volatility and the concerns, especially those who are at or close to retirement, because they have this nest egg that they've built up, and so they want to make sure that that nest egg is preserved over the long term, and so because they'll have that next 20 or 30 years that they have to live off that retirement savings, plus if they want to leave anything to their estate beneficiaries and so on.
Now I do have a question. You do read and you hear about clients. One of the reasons why the U.S. market has done so well, at least the big indices like the S&P 500 have done so well in recent years, is people auto allocate with every paycheck. Their 401k. There's some whatever they put in the 401k, they auto allocate for buying into these indices. Do you see a lot of that? Is that really like quite accurate? There are a lot of people, every paycheck something goes in the S&P 500.
Yeah, when you take a step back and think about just market flows, uh, a friend of mine, Mike Green, has written extensively on passive flows into indices. And so when you think about like a 401k contribution, most 401ks are allocated towards, a combination of index funds or target date funds. And so those passive flows are going to come into the market regardless, because they're continuing to dollar cost average into their retirement accounts. And so those flows are real, and we see those. Even with our existing client base, those that are in non-retirement accounts or even those that have retired, we'll still see some of those flows that come into those index ETFs and so on. So I think that that does provide some level of stability for the equity markets, just the mechanism of that flow.
So that really hasn't changed. There are probably not too many folks who says, I want to reallocate into cash and or money market funds instead of the markets as they have, through recent years. That no real change in that.
No, and I think it's because many of us have learned from the lessons of the past. I'm thinking about April of last year in 2025. There was and it may have been March, but we'll just say Q1 2025, somewhere in there. But this was after Trump was elected, the market sold off, and then there was one day where the Dow Jones jumped 3,000 points in a single day. And so I think many investors have been educated, either through reading on their own or through experiencing market volatility, that it's difficult to time both the sell-offs and the subsequent rebound. And so many of them stay invested and just keep dollar cost averaging in.
Certainly, you're absolutely right. If you said the S&P 500 low was after tariff liberation, it's 48.35. Have you told me you would make new highs above 6,000? I don't think the professionals got that right. And I think once again, the professionals are, I don't think many people would say that, with oil where it is now, that we'd be over 7,000, at all-time highs. I mean, what is that about? So here's the next question is if you, and I guess you uh, answered it in a way, but if you told me it's 7 weeks into a war with Iran, oil $25-$30 higher, there's a blockade going on, and we're at all-time highs. I mean, I'd probably be calling. I don't know what you're eating or smoking, but I'd like some of it. So, um, do you, what are you telling clients who are asking you this question? Do you think just stay invested, or try to rotate into more, quality names or slightly more defensive sectors? What kind of advice are you giving some of these clients who call in, or changing your model portfolio, I should say, if at all?
Yeah, a couple of tactical solutions that we've provided to our sales team, so this would be our advisors, is one to think in terms of balancing risk. We've I mean, we've experienced the last 10 plus years of the Magnificent Seven and its massive run up over, and so a lot of people got used to that trait, right? So you invest in the Mag 7, it's trending upwards. But now we have to get back to fundamentals and to think about diversifying outside of just large cap tech growth. And what I've been talking about for the last, gosh, really since middle of last year is, valuations were high
Mm.
in large cap tech. And so to think about diversifying into that next level down of the AI build out. So we have um, the AI infrastructure build out, industrials, materials, energy, utilities, and all of those companies in my mind would catch a tailwind. And this was like 6, 8 months ago, would catch a tailwind with the amount of dollars that are being deployed to build out the AI infrastructure. So really beginning, like I said, middle of last year in 2025, really looking at diversifying those portfolios in between like a large cap tech, large cap growth, and large cap value. And that's really helped to kind of level some of the playing field, or I shouldn't say minimize returns, but helps to offset some of that volatility that we've seen in large cap tech. In addition to that, the other really interesting thing that's happened is that fixed income yields are substantially higher than they were 5, 6 years ago. So fixed income is now a viable asset class, especially for savers and those who are retired, because now they can clip that coupon. And bonds have historically been a way to add, I don't want to say uncorrelated assets, but less correlated risk to a portfolio. And then the last tool that we have in our toolkit is managed futures. And managed futures is truly an uncorrelated asset class compared to equities and bonds. And managed futures, for those who don't know, are essentially these funds can take a long or a short position across any number of sectors across the economy, whether it's equities, equity futures, interest rate futures, commodities, precious metals, and so on. And if there's a trend, they can step in, and the idea is that they want to make money whether that segment of the market's going up or down. And so managed futures has really been a good diversifier. Now, one of the things that I consider when discussing managed futures is the size of the allocation, because really managed futures is one of those sectors where like a 5 or 10% um, allocation provides that benefit, that diversifying benefit, that uncorrelated benefit. But any more than that, then it seems like people are getting too heavily invested in it. So use it as a tool, but not necessarily like an all or nothing.
So does Trajan run its own managed futures funds, or do you outsource the management of that to somebody else?
Yeah, we outsource the management of that. And then the last thing I'll say is that one of the sectors of the markets that we have deployed here at Trajan Wealth is an allocation to alternatives, specifically private equity. And our program is that our clients are coming in. Well, let me back up. We've curated um, opportunities for our clients to come in, those who are qualified or accredited, to come in as limited partners into some of these funds. Now they have a longer time horizon, but again, it helps to diversify that risk, whether it's in venture or infrastructure or real estate. But that's another offering that we provide that's been beneficial to our clients.
I want to drill a little bit into the some of these alternatives. In terms of private equity, is there concern that, I remember there's a famous quote recently that we have more private equity firms now in this country than we do have McDonald's, which seems like that's an awful lot. Are we in the later innings of this private equity cycle in terms of the return, some of the returns are starting to diminish, and is it a place where you have to be a lot more careful than you used to, and who you curate it? And does Trajan curate those firms or those investments for clients?
Yes. So to answer your question, yes, you have to be careful. You have to do due diligence, and each one of our opportunities are are curated. So essentially, we have a team that we go and provide all the due diligence for the private equity firms themselves, and then the due diligence of the opportunity. And then we negotiate management fees, the typical 2 and 20, we
Right.
negotiate the management fees there. And then the minimums are substantially less than what you would get at some of the large investment banks. So for our clients that are coming in, our minimums are generally around 100 to maybe 200,000 in terms of a minimum investment. And so that's really the powerful thing we can do is even within that private equity sector, we can help our clients diversify, whether it's through a real estate or a venture fund and so on. So we are doing all the due diligence. Generally speaking, I steer clear of the fund to fund strategies. So this is where you have an interval fund where there's one of these large companies that provide an interval fund where it has limited to no liquidity going into it, but also there's layers upon layers of fees, and you can't really do the due diligence into the underlying holdings. And we're seeing that play out today in private credit. And with private credit specifically, these are in theory senior secured loans. But if you're in a fund of funds type strategy, as an advisor, you don't have optics into the who the underlying borrowers are, what segment or sector of the economy that they're in, what their loan performance is, whether they're 60, 90 days delinquent, foreclosed, and so on. And you really don't know what the what the status is of the collateral that's backing that loan. So from that perspective, we want to make sure that we've done all our due diligence, we have optics into it, we know the performance of the underlying investment and so on, because we want to make sure that we've done enough or and more to help our clients understand exactly what they're getting into, the time horizon, and we want to have a seat at the table with these private equity funds to make sure that we know the underlying performance of those investments.
So, you said 100 to 200,000. I guess these you would probably have to be an accredited investor to be able to invest in that. Would that be accurate?
That's right. That's right. Typically, it's a accredited investor. We've had some that are qualified investors, but really we focus in on accredited.
And when they invest in something like that, and do they have liquidity in terms of like how often can they move funds in, move funds out? If you're, as long as it's not you're not giving away proprietary information.
Yeah, from a liquidity perspective, that's one of the keys to understanding private equity, especially if you're coming in as a limited partner. And one of the things that we communicate and educate our clients on is understanding that you have to go into it uh, with an understanding that there is no secondary market for it. You have to go through the investment life cycle that we call it the J curve, where you have the initial investment phase, you have the development phase, and then the harvest phase. And some of these funds can be outstanding for 8 to 10 years. Some of them that we've curated are shorter, but each one of them we make sure that we educate our clients in terms of there is a lack of liquidity, but that's also why we should be able to capture that illiquidity premium.
Right, right. The idea that you can, you can invest longer term. You don't have to worry about the quarterly earnings. You don't have to worry about, mark to market and the shareholders meeting every year, or or the quarterly earnings type things. It certainly I can understand that. Um, you mentioned private credit, and we're having some issues with it. What do you think of private credit at this stage? Is it something that is it more of a sort of a little pothole, or are we talking about a more potentially more serious problem here, especially with some of the later investments?
I I have my reservations about private credit, specifically private credit interval funds. So with a private credit interval fund, and this is kind of the typical structure. So I'm not talking about any specific fund, uh, but essentially with an interval fund structure, the idea is that you invest and these private credit funds will offer roughly 5% for liquidation on a quarterly basis. But what we've seen is that there were some hiccups last year with some of the loan performance, particularly around first brands. And so that caused a lot of investors to run for the exits. And there was a massive redemption request to each one of these funds. And some of those funds capped at that 5%. And so from that perspective, there is some concern about loan deterioration, loan quality, particularly to those that are software companies. Um, it's difficult because we saw with Claude Anthropic and the announcements that they made earlier this year, late last year, that Claude can now replicate a lot of that software engineering. And so then the question is well, what's actually backing these loans? If we're looking at just intellectual property or IP, then what's that IP actually worth if there's a default in that loan? So that's one of the big concerns. And so from that perspective, what I consider is like let's look down to the underlying credit fundamentals. And with interval funds, we don't have those optics. The other area, so the question is it systemic risk? Because we saw that during the '08 financial crisis was systemic risk, and that was the talking point. But from but now I don't know if it's systemic risk. I think that remains to be seen. But last week we had some major banks that announced their earnings, JP Morgan, Citi, Wells Fargo, Bank of America, the big four banks. And what we learned is that their exposure to private credit is somewhat limited. And and I know that it seems to be a talking point with the Federal Reserve, which is one of the key bank regulators. So I don't know that we'll see that systemic risk play out into the large banks. We saw some regional banks that took hiccups last year with their exposure to first brands, but we haven't seen that necessarily materialize in the banking sector itself. So it seems to be somewhat isolated at this point.
I mean, it's kind of a relief. The folks who took took chances and put money in, they may be at some level of risk, but it's not going to be a contagion that affects sort of everybody, or it hasn't gotten big enough, for it to affect everybody. Um, in terms of the other one market I do want to ask you about, and then what your clients are thinking about is crypto. What are you thinking on crypto? What are the clients thinking on crypto? Hit all-time highs in October, dropped dramatically, and now sort of trying to maybe grind its way back up. But what do you think of that as an asset class, and what are your clients thinking?
For crypto, generally speaking, we consider it speculative. And we don't have a product where we offer any crypto exposure to any of our clients. So having said that, I can give you my personal
Mm-hmm.
opinion, which is, crypto seems to be a medium of uh, exchange, right? A medium of exchange between counterparties. And so from that perspective, I understand its purpose. And I understand that, even with Bitcoin, you can buy a partial Bitcoin and invest that way. But long term, there's nothing that's really backing it other than supply and demand. And so at least with the US dollar or a US Treasury note, it's backed by the full faith and taxing authority of the US government. But with crypto, I still consider it speculative, and and it's just not something that we dabble in.
And don't we, a lot of our viewers, quite interested in things like precious metals. Thoughts on, precious metals have had, a pretty volatile year so far. Gold and silver, what are you thinking about assets like those?
Yeah, so gold and silver specifically, what's interesting about gold is that it's historically viewed as a store of value. However, what we've experienced this year is that flight to quality. So as investors, I mean, with the market volatility, when we think about the war in Iran, there's been a movement of clients to safety, so a flight to safety, and the beneficiaries are U.S. Treasuries and the U.S. dollar. And so that's one of the major reasons we've seen that volatility in gold prices. Central banks have been buying gold all throughout 2025. Uh, my reading is that some of them are selling that off. And so, in terms of a store of value of a diversifier, it makes sense. Silver is interesting because it can also be viewed as a store of value, but it's also used in industrial production. So the demand for silver should be there as well. And I think that that's also why we're seeing some of that price fluctuations in silver.
Yeah, silver can really be a bit scary. $120 down to 60, now back up to 80. Not for the faint of heart, I would certainly say. Sort of a longer term thought question. So, the impact of this war, even if we had a ceasefire, you know, this week and oil really started flowing, which looks, I think, perhaps a bit dubious. Um, the impact from these higher oil prices and other things that flow through, like fertilizer, fertilizer for the world, a lot of it is coming from that area, coming through the Strait of Hormuz, and also helium, which apparently, as I understand, is important for manufacture of semiconductor chips. People are saying we won't feel the impact for months. With that, given that thought, are there any strategic alterations that you're thinking about for the model portfolio that, for the medium or even long term, that now that we've had this, event that no one really fully expected and didn't expect the impact, are you thinking that this changes that dynamic? Do you want to, tweak the portfolio in different ways, like, maybe more consumer staples and less consumer discretionary, as we go into sort of the second half of the year?
Yeah, so I'll start with the macro picture. So I'm a top-down macro
Mhm.
investor, and so when we think about the global macro stage, especially here in the United States, we have GDP that's slowing. We have a labor market that's softening but not collapsing, but we still have persistently high inflation, and we've had that persistently high inflation for the last several years. And so really higher oil prices bleed into everything across our economy. And not only things like prices that we pay at the pump for gasoline, but also shipping costs and manufacturing costs and petrochemicals, everything from propane to butane to jet fuel. So now transportation companies, specifically airlines, are going to have higher fuel prices. And all of that essentially eventually gets passed down to the consumer and to business and manufacturers. So those prices will show up. And as a result, in the United States, the consumer is roughly 65-70% of our economy. And once the consumer demand starts to pull away, because now consumers have to think about when I go to the store, what are the things that I need and what are the things that I would like to have? And the dollars will eventually flow to those things that we need versus those that we'd like to have. And so that is an insight to think about consumer staples versus discretionary, lean into some of these sectors that can pass on that higher inflation cost to consumers and businesses. So I think that my read is that consumers are already stretched thin. When you look at the loan data, credit card debt is higher, auto loan debt's higher, housing debt is higher. Now we have persistent inflation that's being amplified by higher oil prices. So the consumer has to pull back at some point. And so because of that dynamic, I think in terms of, okay, let's look at those sectors that will benefit not only from the higher oil prices and defense spending, but also those consumer staples. And also in the back of my mind, I still think about that AI infrastructure build out because all these data centers have to be built, and that includes everything from manufacturing, construction, energy producers, utilities, and so on. So that tells me to lean into those sectors that will participate in that build out.
It will be interesting. We're seeing some earnings now. It'll actually be the quarter two earnings. They'll probably tell us a lot whether a lot of folks are seeing their revenue, the corporates are seeing their margins compress because, as you say rightly, the consumers are a little stretched. How much of the additional costs are you able to pass through? But unfortunately, we probably won't see that for another quarter or so. Um, in terms of AI, what do you think the impact will be in terms of the job market? Some people always say that, oh, new technology creates jobs that we can't imagine, but then that transition could be pretty difficult. I mean, what are your thoughts on that? Because everybody's asking, and it's hard to get a satisfactory answer.
Yeah, I lived through the tail end of the computer revolution in the 80s and obviously the internet revolution of the 90s. And if I look back on those two instances, essentially what happens is there is a dislocation in terms of job skills that are required to lead that next phase. And so in my mind, I think that this provides opportunity. And for anybody who's working in corporate America, my thought is to lean into AI technology and become the expert in your firm or your company to understand it. And so we don't know what's on the other side of this, but I'm a future is bright kind of investor, and I think that there's going to be something on the other side. What that looks like, I don't quite know. But what I can say is that in our age cohort, because you and I were talking before the interview started, I'm assuming we're sort of right around the same age, and and so with our age cohort, we have the knowledge base to understand if what AI is producing makes sense. And so from the younger generation that's coming up, yes, use it as a tool, learn it, develop it, and but also try to build that understanding of whether the output or what you're reading in the results makes sense. And that's where our generation can help inform that younger generation that's coming up, is to pass on that knowledge and wisdom that we've gained over the course of our career. So, but I do think that there could be some labor market volatility because of it, and we've already seen it in the software section, but it will permeate into other sectors of the economy. And in my mind, the way to think about it is it's happening, so lean into it and become that expert.
It makes a lot of sense. You want to I think say I'm going to be the best person in the firm doing this, and we're going to be a lot more productive doing it. That does make a lot of sense. And final question. Um, at these levels, would I think only 3 or 5% of the names in the S&P 500 are actually making all-time highs, but the index is up there, so the breadth is narrow. Um, would you say this is a time to maybe look for a little insurance? I mean, we talked about sectors, little sector, sort of rotation. But would you recommend something like, potentially using options to protect some downside in case this is a top of the market and something goes wrong, and we retrace substantially?
Yeah, absolutely. And from a risk management perspective, with risk management, what I'll say is that typically speaking, you can accept it, avoid it, or diversify it. And so the vast majority of the time, one can diversify that risk, and that's investing in sectors outside of that large cap tech, adding fixed income, as we talked about, even like a managed future sleeve and alternatives and so on. But options can play a role. However, what I'll say is that when retail investors, so I would call that sort of the mass affluent, and that they have to be careful with option strategies and to know exactly what they're doing, because I've seen some folks get on the wrong side of that trade. And so if you're buying a put option or buying a call option or so on, creating a straddle, uh, that's one methodology to manage that risk. But just be careful. That's my only advice there, is just be careful with option strategies. Make sure you know what you're doing, or that you're investing with an advisory firm that understands that and can deploy that strategy on your behalf.
Oh, actually, one more question. And this was a big theme before this whole February 28th happened. Going overseas, buying Europe, buying emerging markets. What's your view on, potentially diversifying overseas? Also, the dollar has gained a bit, although not as much as people imagined with this war. Um, if we go back to the idea that people are trying to invest outside of the U.S. and the dollar is in secular decline. What's your view on taking some portion of your assets and taking it outside of the U.S. borders?
Yeah, I like that idea. One, because it diversifies you across geographies. So that's one idea. But also, I think there's opportunities in different countries. So for the most part, I think people can get access to emerging markets or international exposure in an ETF type format. One of the areas that we focused on is taking active tilts to specific countries. So I'll give you two examples. One is Switzerland, because historically Switzerland has been viewed as a store of value. Their currency has historically been stable, and it's more of the stable side of the barbell. On the growth side, there's countries like India that have the demographics and the population growth and people that are moving into middle class, and they're going to start spending. And so that's one country that I think is kind of an interesting place to invest. Again, for those who don't understand like the total foreign currency movements, it's difficult to gain access on your own and investing in specific companies, but in like an ETF type format, then that exchange rate is embedded within the fund structure itself.
Yeah, the ETF revolution is amazing. It's democratized it so much that you can get access to, countries like India, which would be pretty difficult to do on your own. Well, David, thank you so much for spending so much time with us, giving us some guidance in the middle of, so really, really substantial market turmoil. Thanks again.
Thank you.